The history of stock exchanges is a fascinating journey. It began with informal gatherings in medieval Europe and evolved into the sophisticated, interconnected electronic platforms we use today. Early markets addressed the critical need to manage financial risks and create efficient mechanisms for trading various types of securities. Understanding this evolution helps us appreciate the complexity and importance of modern financial systems. In the 13th century, Venice emerged as a crucial hub for early financial innovation. Merchants and moneylenders in the region were instrumental in developing the practice of trading debt. Their efforts laid critical foundational principles which were essential for the evolution of future financial markets throughout Europe. Understanding these early beginnings helps appreciate the complex financial instruments we see today. By the 14th century, public debt trading expanded significantly from Venice to influential Italian city-states like Genoa, Florence, and Pisa. Bankers in these regions actively traded government securities, formalizing the exchange of public debt. This crucial development fostered the emergence of early capital markets. It marked a pivotal step in financial history, establishing important precedents for structured financial transactions and investment across Europe. In approximately 1330, an early form of a stock market was operating in the square outside the Van der Beurs family inn in Bruges. Italian and other foreign merchants gathered to trade bills of exchange and other securities. These transactions were often handled over the counter at specific meeting spots. Bourse, a term derived from the Van der Beurs family name, became the generic word for stock exchange in several languages. In the 16th century, Antwerp took over the role of trade center from Bruges. The establishment of its formal exchange in 1531 was a pivotal moment, focusing on financial instruments like promissory notes and bonds. This early financial market innovation laid foundational elements for the development of modern stock exchanges we see today. It demonstrated a sophisticated approach to finance for its era. The Amsterdam Stock Exchange, founded by the Dutch East India Company, marked a significant milestone in financial history. Before this, trading was informal and localized. This institution provided a formal, regulated environment, allowing investors to buy and sell shares efficiently. This innovation was fundamental for financing large-scale ventures like global trade and exploration, laying the groundwork for modern financial markets and the concept of public companies. Developments in early financial systems were instrumental in shaping the global financial landscape. Risk diversification allowed investors to spread capital across multiple ventures, effectively minimizing individual financial risk. Vibrant secondary market facilitated the active buying and selling of shares, enhancing liquidity and investment flexibility. These mechanisms established the essential framework for the development of today's global stock markets. Before formal exchanges, London stockbrokers, often considered rowdy, found a new home in coffee houses. Jonathan's Coffee House in particular was vital. It was where informal trading rules were forged, connections made, and the groundwork for modern financial markets was laid, showcasing the dynamic nature of early commerce. The Philadelphia Stock Exchange, founded in 1790, was the first in the United States. Its establishment marked a pivotal moment in American financial history, creating a formal marketplace for securities trading. This early financial center was instrumental in facilitating capital formation and economic growth, supporting the nation's nascent industries and infrastructure. It provided a structured environment for investment, crucial for the country's early development. The Buttonwood Agreement, signed in 1792 by 24 brokers on Wall Street, was a landmark event. They committed to trading securities exclusively among themselves, thereby creating a foundational closed trading network. This agreement was a direct precursor to the New York Stock Exchange, shaping the future of organized finance. Prior to this, trading was informal. This marked a significant shift and established New York as a financial hub. The informal meetings of London brokers evolved into the London Stock Exchange in 1801, marking a significant step in financial history. The LSE's formalization provided critical structure to the market, introducing standardized rules and practices. This foundation was crucial for building trust and attracting investment, ultimately boosting market efficiency and establishing London as a leading financial hub globally. The outline details the early history of the New York Stock Exchange. Initially, the group implemented fixed commission rates, a crucial step in regulating the nascent financial market and ensuring standardized practices. Its formal establishment as the New York Stock and Exchange Board in 1817 marked a significant organizational milestone. The move to its first permanent location in 1865 underscored its substantial growth and increasing importance in the financial world. Before the stock ticker, market information traveled slowly, often via handwritten notes or telegrams with significant delays. The ticker's real-time updates were a game changer, democratizing access to crucial financial data. This rapid dissemination allowed investors and brokers to make quicker, more informed decisions, drastically improving market liquidity and responsiveness. It laid the groundwork for future electronic trading systems. The Nasdaq's launch in 1971 fundamentally changed how stocks were traded. Before Nasdaq, trading was largely a manual process conducted on physical floors. Nasdaq introduced an electronic system enabling faster, more transparent, and accessible trading. This innovation paved the way for modern financial markets and demonstrated the power of technology in transforming established industries, making it a truly monumental technological leap. Early stock markets faced bubbles and crashes. The South Sea bubble of 720 was a financial crisis in Britain that occurred after the stock price of the South Sea Company dramatically and speculatively increased, then crashed. As unrealistic expectations and fraud inflated the stock price, a speculative frenzy led to the company's shares skyrocketing before the bubble burst in late 720, causing widespread financial ruin for investors. The Wall Street crash of 1929 triggered a profound economic downturn, the Great Depression, which exposed severe weaknesses in financial market regulation. This crisis spurred the U.S. government to enact significant reforms, most notably establishing the Securities and Exchange Commission in 1934. The SEC's mandate was to restore investor confidence and ensure market integrity. The ongoing modernization of financial markets was profoundly shaped by significant events such as Black Monday in 1987 and the 2008 financial crisis. The 1987 Black Monday crash led to quick technical fixes, circuit breakers to pause trading during extreme volatility. The 2008 financial crisis demanded sweeping structural reform through Dodd-Frank and Basel III, which raised bank capital requirements, introduced mandatory stress tests, and required central clearing of derivatives to reduce hidden risks. As of late 2025, the world's stock exchanges continue to serve as the backbone of global capital markets, facilitating trillions in daily trading and listing over 50,000 companies collectively. Market capitalization remains the primary metric for size, while trading volume gauges liquidity. Together, the top 10 exchanges account for over 80% of global equity value, exceeding $110 trillion. Key players are NYSE, NASDAQ, and the Shanghai Stock Exchange, SSE. Stock exchanges worldwide are undergoing a profound transformation, driven by technological advancements, regulatory pressures, and investor demands for sustainability. As of December 2025, this evolution manifests in two core pillars: faster trading through automation and AI, and greener practices via ESG integration. These shifts not only enhance efficiency and resilience, but also position exchanges as enablers of global capital flows in an increasingly interconnected economy. The future of stock exchanges is being reshaped by digital innovation. Technologies like AI, blockchain, and cloud computing are driving unprecedented efficiency and accessibility. While these advancements offer significant opportunities, they also present challenges in security, regulation, and increased market competition. Understanding these dynamics is crucial for navigating the evolving landscape of global finance. Thank you for watching, and see you next time.